Hello, everyone. This is Jason Su from Rayliant Global Advisors. Today, I'll be talking with you about applying machine learning to help you invest better in the Chinese equities market. Now, a lot has been said about machine learning. What I want to say today is that machine learning doesn't just magically give you alpha. It actually takes a lot more work to make it work properly. And in fact, when it actually works properly, it mostly tells you that a lot of your alpha modeling work is noisy and is data mined. Now, don't be depressed by that because that's actually quite useful, because only when you know how much of your work is data mined and how much is actually truly useful signal can you then really extract the signal from the noisy data and find interesting relationships to predict future stock returns. So let's take a look at how machine learning might work when applied to US data. Now, if you do your research right, it's likely that when applying the technique to a very efficient market, machine learning will tell you, hey, just buy the S&P 500. So where machine learning is truly interesting is applying to a very inefficient market. And in this case, China would be one such market, 85% retail trading and very inexperienced traders. And China happens to be quite important because it's a very large equity market, the second largest today, and perhaps likely to grow to the size of the US in terms of its benchmark weight over time. So having a very large alpha reservoir is very exciting, but how do we extract that alpha from the Chinese equity market using machine learning? Well, there is an obstacle. It is that the Chinese equities data is very short. It's barely 15 years old. And of course, the first 5 years is completely not representative of what the Chinese equity market is today. And so if you have just under 10 years of data, it's very hard to say anything. And machine learning certainly needs a lot of data to really find out patterns. Now, this is where you can be clever and understand that, hey, machine learning looks at data and learns about data and then predicts the future. So you can have the machine to learn about China by using US historical data, using global historical data, using historical data from other emerging economies, where there were parts of that history when those markets were more inefficient, more like what China is today. So it's using US to predict China today. And the funny thing is, historical US data is actually far more useful for predicting China today than it is for predicting US today, because the US today is simply too efficient relative to its history. And of course, the nonlinear interaction module is quite useful because there are specific factors and specific attributes in China that interact in interesting and nonlinear ways. And when you put all that together, machine learning can help you unlock the tremendous alpha potential that is available in the Chinese equities market. And given that the Chinese equity market could likely become 20–25% of the global equity market benchmark over time, that's a very, very significant way to add to the alpha of your equity portfolio. So before signing off, I'll probably leave you with one last thought, which is while machine learning is very sexy, don't fall in love with it too much. Do understand what it actually can and cannot do. I think there's a lot of sort of missed advertisement out there. And if you really understand how it works, you'll discover that more than anything else, it keeps you really honest on what is actually possible when investing quantitatively. All right, that concludes my formal remark. Now I would like you to join me in the live stream for some Q&A.
Okay. Good day, Jason. I don't know where you are located at this moment, but I'm very glad to have you here, live in the live stream of the Financial Investigator event. We just saw your clear presentation, and I see before me here an audience, but also a team of 3 panelists that would like to raise some questions to you with regard to your presentation. And maybe I can ask Reinier to kick off with his questions to you.
All right, Jason, thanks for your presentation. It was quite clear to us. I have a quite long question for you. I will introduce that. For a market with generally lower standards in reporting quality and accounting integrity, can the quantitative method that's completely data dependent, like machine learning, still work? Given the level of retail market participation, you expect China to be a fairly inefficient market with large potential for alpha. However, the relevant historical data are very short. Now my question, can machine learning still be applied to create strategies for accessing alpha in China, given the short data issue?
Thank you. So first of all, I'm actually broadcasting from Boston. I have a virtual background.
Okay.
Yeah.
Hi. In the morning. Yeah.
So I have a virtual background. This is Star Trek.
We saw that.
The Starship Enterprise.
Good.
Okay. So with regard to the question, so I think I'll address two dimensions. One is about the shortness of data. You're absolutely right. If you look at the amount of data we have to analyze either Chinese corporate financials or just price and volume data, at best you have 15 years. And certainly of the 15 years, probably only the last 10 years is relevant, right? Because the first 5 years, there was very little trading, very few companies were traded. So that is complicated from any statistical methodology, much less applying machine learning, which really requires a large amount of data. The way to overcome that, though, is not by sort of staring more at Chinese data and hope somehow magically you could overcome the shortness of data problem. What you need to do is to take global data. You take data from the U.S., from other developed Asian economies, from other emerging economies, and there the trick is the patterns you're looking for in China today has occurred before in the past, historically, in the U.S. In, say, Taiwan, in South Korea, in Japan, right? There was a time period in the U.S. history, in Japan's history, in Korea's history, where the market is relatively inefficient, where there's quite a bit of retail trading, and where the market participants are not as skilled and exhibit varying degrees of behavioral biases that you can take advantage of. And while those patterns are much weaker now in the U.S. today, in Taiwan, in Korea today, they show up quite strongly in China. So this is a way of using sort of an augmented data set that is not China-specific, but yet that contains a lot of information on, say, what retail investors are likely to sort of commit as mistakes in China today. So that's one way to handle the shortness of data problem. The second dimension, again, related to data, but this time it's related to the fact that when you look at the quality of the reported financials, certainly they're of a different quality, not quite global standards. And so as China is still trying to converge to global standards, trying to converge to global sort of auditing and best practice in governance and transparency, you'll question the integrity of the data, right? And so this is another issue with the data, right? It's not just the shortness of it, it's just the integrity. You question whether you can trust the data. Now, the good news there is that this is something we actually know how to deal with, right? There is a very vast literature from accounting. So it's under the research banner of forensic accounting. Basically, you can look at, income statement, balance sheet, and get a sense of, are the numbers likely conservative or aggressive, right? Is there something weird going on there? And with machine learning, given that there's so much accounting data available, both from the company itself, but also other companies within the ecosystem, right? Upstream, downstream companies. Machines are actually quite good at piecing together all that data, piecing together all the accounting red flags, and start to question, hey, you have amazing margin and you have amazing earnings growth, but no one else within your own industry segment in upstream or downstream exhibit the same characteristic. Something's going on there. And again, with machine learning, you're much more able to pick that up versus, say, a human. So in conclusion, yes, shortness of data is always a challenge. But in this case, you can be clever about it. China data is short, but the history of financial market is quite long. The history of how retail individuals misbehave and create alpha opportunities is quite long. And the other part is, yes, slightly more problematic in terms of data quality, but we know a lot from the vast accounting literature, and the machine learning tools actually is quite good at sort of finding out much more subtle red flags that, say, a traditional fundamental analyst would struggle with.
Thanks.
Okay, thank you. Let me see. Harry, would you
Yeah.
have a question for Jason.
You said that the alpha from China is actually the biggest one, is maybe even likely to dominate global alpha production. Is that because the China market is so big, or is it because so inefficient, this market?
Yes, so there, again, two dimensions to this. For a economy or market to be a large alpha reservoir, well, you have to first of all be very large within the benchmark, and second of all, you have to be very inefficient, right? So let's just take the emerging market index. Today, China, after the adjustment in the inclusion factor, is likely to become close to 40%. Perhaps by the time of full inclusion, China's market would have grown more. It might actually get closer to 50% of the emerging market. So first of all, just from a benchmark perspective, right? This is the one country within EM that has the largest weight. And so, if you're able to generate alpha for that benchmark exposure, it's much more meaningful to outperforming the broader EM index. So first of all, that's really important to understand. If you want to invest in sort of resource and technology to mine alpha, it's best that you invest that in a large benchmark constituent. So China does benefit from just being so large as a capital market. But the second part is you also need that market to be inefficient, right? Just because China is big doesn't mean it'll necessarily be inefficient to have lots of alpha. And usually what you see is larger economies. The U.S., Japan, Germany tends to be more mature, and there's not a lot of alpha. So China, in this case, is actually quite unique. That is both large and quite inefficient. Now, it's not just any kind of inefficiency. A lot of us think of inefficiency as, if it's a young country that doesn't have robust financial institutions, that probably doesn't have very sophisticated regulators, it's inefficient. But we actually need something that's a little tighter in terms of what we talk about inefficiency. This is really about the supply of alpha, right? So a market can be very inefficient, but if it doesn't have a lot of trading, doesn't have a lot of retail individuals who are speculating and making mistakes, well, there's not a lot of alpha to be had, right? Because at the end of the day, alpha is a zero-sum game, right? You've got to have a lot of people on the other side of your alpha trade. And generally, they have to be inexperienced retail individuals who trade a lot. Again, in China, you have 80–85% retail trading, so that's the good news. That's a large reservoir. So you got a very large benchmark weight that has 85% sort of speculative, uninformed trading, and that really anchors the source of alpha. And particularly in the context of machine learning, it tends to pick off a sort of repeatable pattern, so much more sort of behavioral patterns than, say, just random shock to policies or to market cycles. So the fact that it's quite retail individual and therefore quite more sort of behavioral bias-based alpha is the other good news for people who are applying the machine learning technique to mine alpha in that market.
Thank you, Jason. Maybe Han, you have another question for Jason?
Yeah, Jason, I can understand machine learning works very well with identifying pictures or maybe even driving a car, that a machine can drive a car. But financial markets is a different animal in the sense that humans interact and humans adapt. And if I know that your machine is active in this market, I maybe try to front run your machine and maybe interact with other people trying to understand what's happening. And by that, I'm creating a lot of noise maybe for your machine. And the difficulty then for your machine is how to identify a pattern. Maybe they identify patterns that are really not there, so that the machine does not work.
Yes, so while I'm a big champion of the technology and a heavy user of technology, I think I'm also very realistic about what that technology can and cannot do. And you're absolutely right. Like when we talk about machine learning, don't make it some kind of magical black box that just solves problems that we humans can't solve. It is actually quite limited in what it can do. There's a few things it does well, which is detecting patterns that repeat. But outside of that, it really doesn't do very much, right? So if you're talking about a pattern that doesn't exist, right, machine learning is completely hopeless. So you're absolutely right. Financial markets is filled with patterns that have never been seen before, right? So if you're asking machine learning to help us understand, well, what should asset prices look like in a world of negative interest rates? Sorry, the machine can't tell you that because we never had negative interest rates before, right? It can't predict COVID-19, and it can't predict what's likely to happen to asset prices after COVID-19. Again, just something that didn't exist in data. So it's really important to understand. It's about patterns that repeat. And of course, once you see a pattern with a machine, how do you know if that pattern is going to repeat, right? Like you say, some of it could be just an accident, right? So that comes from just data mining. Now, the good news about machine learning is part of the toolkit is actually quite skeptical. So built into the machine learning is these tool that says, look, if you stare at the data long enough, you'll find something. And so we're going to be very distrustful of data patterns. So either it's a lot of data and then very robust pattern, or we're not going to give a lot of weight to it. So the other thing that you're more likely to fall prey to is something that actually is a robust pattern, but it'll decay, right? Like you say, we are intelligent traders, and when we see a pattern, when we pounce on it, and the pattern goes away. That's how markets work. And so that's actually the most dangerous thing, right? Your machine sees a pattern, but doesn't realize that other investors will discover it and will arbitrage that out. And so this is where you actually, again, you want to be clever about it. So you want to use, say, US data, and you say, look, a lot of signals about accounting fraud. And those patterns, existed in the late 70s, early 80s, and they've gone away. And so, machine can then say, there's sort of decay to that. And now you can apply that to South Korea. You can apply that to other emerging markets, apply that to China, and you say, hey, assuming that kind of decay rate, given in the last few years you saw very large alpha to sort of forensic accounting signals, how long do we expect that alpha to last, and how fast will it decay? So you don't make too big of a bet on it, expecting the exact pattern to repeat. So you're now actually a little bit more intelligent. That pattern will repeat, but just with lower intensity. And that information comes from, again, looking at data that's not China.
Okay. That's good. Thank you, Jason. We just also received a question online via chat, and I will put that up to you. Given that noise needs to be filtered and main signals are to be extracted, how is machine learning different from human pattern recognition?
So yes, so any kind of pattern recognition, whether it's human, whether it's machine, all work the same way, right? It's right. A matter of their signal, and then there are a lot of noise. And in fact, the noise often dominates the signal. The benefit, of course, having a human is human can apply theory when it looks at patterns. Say, is that pattern or is that noise? Machine right now can't, at least for financial markets where the noise is so high. Machine actually often gets fooled or just gets swamped by a noise. So we're very much still in the realm of, say, called guided learning, right? So you actually apply a lot of human intuition and say, this signal makes sense. It's behavioral in nature, or it is sort of risk in nature. You feed that to the machine, and the machine starts to work from there. So it's still very much a collaboration between man and machine.
It's for a big part human work. It remains human work.
A lot of human work.
Yeah.
It's a lot of human work.
Then I have one question for myself to you, and it is: are there examples of successful investing in China equities through machine learning already?
So I would say, first of all, machine learning so far has been probably a lot more marketing than it is great success, right? We have not created a machine that is a rival to a Warren Buffett yet. That's just
right. Yeah, right.
But if you want to say, okay, where has success been? I think success has been in two domains.
Right.
One is quite predictable, which is in the very short high frequency domain. Where you're essentially market making, right? Where you're trying to front run liquidity, trying to front run shift in market depth. That's proven out to work because there's a lot more data, right? Tick by tick data. So in China, if you're a high frequency guy, it's been a very, very fertile hunting ground, far more so than in the U.S. market because less competition. So that's where we've seen very big success. The other success you're going to be surprised by is when you apply machine learning to China, all of a sudden your back test no longer have a Sharpe ratio of 8, right? Your Sharpe ratio now goes down to something that's still fantastic but quite believable. It's closer to 2.5. Yeah. So that's another feature of machine learning that people don't sort of pay attention to, which is it gives you an honest back test. Yeah. So you can credibly understand what's possible, and
Right.
as you're optimizing your portfolio, you don't make unreasonable concentrated bet.
Right.
And then
I
that
think that is
actually
very
works.
clear.
Yeah.
And sorry that I have to interrupt you due to the time frame, the slot where we're into.
Course.
Thanks again, Jason. It was really a pleasure to have you here. And I told the public, the audience, that they will receive your presentations afterwards. Thank you very much.
Thank you. Thank you.